All right, let's talk about Datavault AI's Q3 earnings call because it was a really fascinating one. Today, we're going to get into the numbers, unpack the company's huge vision for the future, and try to make sense of why the market is so split on this stock. And this right here is the central mystery we need to solve. I mean, you see revenue growth of 148% and you think, wow, this thing must have soared. But nope, the stock actually dropped after management laid out their case. So what is going on? That's the great divide we're going to dig into.
Okay, so let's get right to it. The negative story starts with these headline numbers. On revenue, they brought in $2.9 million, but Wall Street was expecting almost double that, around $6 million. So a huge miss. And then on the bottom line, the loss of 33 cents a share was way, way bigger than the 7-cent loss everyone was braced for. Not a great start.
But here's where it gets complicated. Even though they missed the estimate, the actual growth was absolutely explosive. We're talking up 148% from last year and up 67% from just last quarter. So right away, you have this major contradiction, a big miss on expectations, but massive underlying growth.
Now, as you can imagine, management completely leaned into that growth number on the call. They basically ignored the miss and started painting this picture of a massive $200 million future that, frankly, sounds incredible if they can pull it off.
And the CEO, Nathaniel Bradley, really framed this whole thing as an inspirational moonshot. He basically said, look, I'm not setting some easy, low bar we can just stumble over. I'm setting an audacious goal to get my team fired up and aiming for something huge. And what a goal it is. The company literally quadrupled its 2026 revenue guidance. They took it from around $50 million all the way up to $200 million. I mean, that one number is pretty much the entire bull case for this stock. So how on earth do they think they're going to get there? Well, it all hinges on what they call their platform of platforms. It's a 3-step process. First, they refine a customer's data, help them figure out what they have. Then they vault it, using AI to put a real dollar value on it. And finally, the exchange. They trade these newly tokenized assets on their own platforms, taking a small fee on every single transaction, kind of like a stock exchange. And they're trying to prove this isn't just a pipe dream. Management pointed to a string of big deals they've signed, a $10 million license here, an $8 million tokenization deal there. But the big one, the one that underpins this whole story, is a pending $150 million investment from Scilex that's supposed to fund this entire vision. So you've got this amazing bullish story, right? But the market wasn't buying it. And that brings us to the other side of the coin, the reality check. We're talking cash burn, profitability concerns, and some pretty serious investor skepticism. And here's why. The financial picture right now is, well, it's pretty brutal. They lost $33 million in a single quarter. Gross profit was just $100,000, which gives them a razor-thin 3% gross margin. And that net margin? It's just a world away from the high-margin business they're promising for the future. And here's the real disconnect. You might be asking, where's their money actually coming from today? Well, more than 3/4 of it is from an old live events business they acquired. It's not the futuristic, high-margin tokenization business they're pitching. That part is barely making any money at all right now. And all of this leads to the biggest red flag of all. They are burning through cash like there's no tomorrow. They ended the quarter with only $1.7 million in the bank, after burning through more than $23 million just this year. That makes the pending $150 million investment from Scilex, well, it's not just a nice to have, it's an absolute necessity for survival. You can really see the whole drama play out on this timeline. The stock first popped on those big growth numbers. But after the call, once investors really dug into the cash burn and the risks, it started to sell off. Now, everything, and I mean everything, comes down to that shareholder vote on November 24th to approve the Scilex money. So, let's put it all together. We've got the wildly bullish story from management and the pretty scary reality of the financials. Let's synthesize the two and come up with a verdict and a prediction for what's next. It really just boils down to this fundamental conflict. The bulls see a visionary company with explosive potential, and they believe the $150 million in funding takes most of the risk off the table. The bears, on the other hand, see a company with massive execution risk, a terrible cash burn problem, and a business model that's completely unproven. So here's my call for Q4. I think this gap between the story and the reality is only going to get wider. We'll probably see them announce more exciting partnerships to feed the narrative. But the financials? They're going to stay messy. The market's entire focus is going to be on one single thing: Does that Scilex cash hit the bank? And as for the stock, you better buckle up. It's going to be extremely volatile. The price will swing wildly on any news about that shareholder vote or new deals. For the foreseeable future, this stock is going to trade on headlines and hype, not on spreadsheets and fundamentals. So, after all that, we're landing on a final rating of underperform. The chasm between that $200 million vision and the financial reality today is just too wide to ignore. The risk that they can't pull this off is immense, and frankly, the stock seems priced for a perfect, flawless outcome that is very, very far from a guarantee. And of course, as always, please remember this is not financial advice.